It's time to break down different ways to protect your assets. Buying a home or an investment property is typically the largest asset purchase most Australians are going to make in their life. So protecting those assets are critical. Whether it's your own home or an investment, we're going to discuss different strategies that you can use to protect your assets and make sure that you're growing your net worth over time. The first topic on our list in terms of protecting your assets is starting with the right insurance. Insurance can become a complicated area, especially as you look to grow out a multi-million-dollar property portfolio and you start making purchase after purchase. If you're just starting out, it can be fairly simple and straightforward, but it's important to understand the product disclosure statement and what you're exactly covered for when you take out insurance on your home. The key area that people are getting tripped up at the moment is the estimated value to rebuild their home. As we can see in the property market, the cost of labor and the cost of materials have gone up significantly over the last few years. And when you take out home insurance, you need to estimate the rebuild value of your property. Emily and I have had to do this, and we try to revalue our property each year and not use the online insurance calculators. These can be a little bit deceiving where you plug in the build quality, the year it was built, and some of the products and materials that we used to try and come up with an online valuation. There's an estimate out there which says the majority of Australians are underinsured when it comes to their home insurance. So make sure you're assessing the value of your home and what it would likely cost in terms of time and materials to rebuild your property. This gives you comfort in terms of the worst case scenario. So if your property was to flood, or you were to have structural issues or a house fire, for example, then you would know you're comfortably covered by your insurance. You might want to also look at contents insurance, whether it's your own home or an investment property. This comes to the individual person. For us, we decided not to go ahead with contents insurance, but for others, it covers things like air cons, like fans, like dishwashers, the items that are within your property. This can be useful for investors if you want to insure things like air conditioners at the property, or if it's your own home and you want to protect expensive belongings like guitars or TVs, PlayStations, all those sorts of things. If you're finding insurance confusing, maybe engage an insurance broker. Insurance brokers are growing in terms of popularity because they allow you, like a mortgage broker, to compare the market and look at what your options are. An insurance broker will look at the types of product, the price premium that you need to pay each year, and the level of coverage you're going to receive. My personal philosophy when it comes to taking out insurance is to only take out home insurance, maximize my premiums, make sure I'm covering the rebuild value of the home, and this will mean I make the minimum repayments for worst case scenarios. Other people like to have a minimum excess so they can claim insurance regularly, but for me, we generally like to self-insure for smaller items and only deal with insurance if it's, say, above a $5,000 excess. This is based on your risk profile and is a personal decision at the end of the day, so make sure you take a detailed look at your insurance to protect your assets. Another way you can protect your home is to look at the type of structure you buy the property in. A lot of people are using company and trust structures to purchase properties to make sure they're held by a separate entity. What this means is if you work in an industry that's such as a doctor or you're a lawyer and you want to protect yourself and hold the assets in another entity, buying in your partner's name or buying through a company and trust structure can be the way to go to protect yourself. Essentially, what this means is the lawyer or doctor in this example doesn't own any of the assets in their personal name. And if they were to be sued, they couldn't use the property or sell the property as collateral because they don't actually own the asset. Now, I've talked about company and trust structures in the past, so make sure you check out one of those videos. But essentially, the structure is you have a company which acts as a corporate trustee for your discretionary trust. And you appoint yourself and your partner as the shareholders, directors, and primary beneficiaries of the trust. What this means is if you use a corporate trustee in a trust structure, you have limited liability because the corporate trustee controls the trust, and it protects your assets because both you and your partner don't hold that property in personal names. Now, there are some increased costs with your accountant and with your solicitors to set these structures up and to maintain them. So make sure you take that into account when you're looking at your cash flows. But this is a way that you can protect yourself and potentially protect your assets. Now, I personally would only look at these structures for estate planning, for tax minimization and asset protection when it makes sense for the cost. But for others, the cost might well be worth it at this point in time. So you need to weigh that up and look at your risk profile and then move forward on that basis. In these uncertain times of interest rate rises, another way you can protect your assets and protect your cash flow is to actually take on an interest-only period. Now, what happens a lot is people roll off their interest-only period and then can't handle the higher repayments. So it's important to have a cash flow buffer of at least 6 months of living expenses and ideally 12 months plus of living expenses to make sure you can manage these changes in cash flows. Going on to an interest-only period is going to make a difference by reducing your monthly repayments. You might be paying $4,000 a month if you're on principal and interest repayments, but you might only pay $2,500 a month if you're on interest-only repayments. What this means is you have $1,500 of excess cash flow that you can park in your offset account, and you get to retain that liquidity. Now, this is not for everyone, but for me, I really love interest-only loans, but it can affect your serviceability as you look to grow your property portfolio. So you need to weigh up the situation and look at each property investment opportunity, work out whether interest only or principal and interest suits you. But utilizing interest only terms can help you build up that rainy day fund, minimize your repayments, and make sure you build up your cash flow buffers. Finally, you can even build up those buffers to allow you to use those funds for another deposit on another property purchase. This is the way you can grow and scale your property portfolio. You make the minimum repayments on your investment assets, you build up your cash buffer until you've got another deposit, and then you go and use that deposit for another investment property purchase. At the end of the day, using interest-only loans is another way that you can help protect your cash flow and make sure you control your asset base. One area that is significantly neglected on investment properties and people's own homes is preventative maintenance. People don't want to do preventative maintenance, I tell you. Other people want to go out and do maintenance when it's required. When you've got the hole in the roof and water's gushing in, that's when people want to do the maintenance. But for me, taking on preventative maintenance is really key to managing your assets well, to making sure the property is being looked after, because you should be taking a long-term view when it comes to controlling and owning your assets. For me, I think of myself as a steward of a property. When we receive requests from our property managers to deal with preventative or actual maintenance that is required on the home, we will consider all of those seriously and try and take those forward steps to protect our asset. Some examples of this could be replacing washers and taps early, putting in newer toilets or newer air cons in the home when the other ones are past their use-by date. This helps you maintain the quality of the home and retains value and potentially adds value to the property. If you're buying a $500,000 or $1 million asset, it's really worth spending $3,000 to $5,000 a year as a minimum budget for your preventative maintenance. Now, of course, you don't have to spend this each year on your maintenance budget. You can build up those cash flow buffers, but you will have some years where you've got larger expenses and some years where you have smaller maintenance expenses. But for me, don't hold off on doing simple things, whether it's replacing gutters, replacing toilets, ovens. There's all these sorts of things that need fixing in a home and an investment property. So make sure you have a budget for maintenance and you take action by organizing the trades or having your property manager organize the trades for you to get the work done before it becomes a major issue. The final item on my list today when it comes to protecting your assets is to make sure you refinance or assess your loans regularly. For me, that means every 6 to 12 months. And sometimes the bank might hike the rates up further than the RBA has. And there's other competitors out there that are offering better rates, or even your own bank offering better rates to new customers. So you need to reassess your financial position, look at whether you can move to another bank or work with your current bank or lender to reduce your rates, and make sure you're structured in both a tax effective and asset planning manner to grow your property portfolio over time. You don't want to deal with issues of cross collateralization or cross securitization where you tie your assets up with one lender and it doesn't allow you to refinance and to continue to grow your property portfolio. So make sure you have standalone loans for each property and you look at refinancing every 12 to 24 months or negotiating with your lender regularly to make sure you're getting sharp rates. At the end of the day, buying your own home and growing an investment property portfolio is going to be the largest assets you control in your everyday life. So looking at these different ways to protect your asset and make sure it holds its value over the long term is critical to growing your net worth over time. This is not always the most exciting stuff. It's probably more exciting when you're buying and making your next property purchase or looking to stage your home for sale. But taking these actions and taking these small steps to manage and control your assets can make a big difference in giving you assurance and protecting yourself at the end of the day. If you're looking for a Brisbane-based buyer's agent to help you buy in this market, then head over to purposeproperty.com.au to book in a free strategy session with myself. We'll have a chat for about 30 minutes, talk about your situation, talk about what we do as buyer's agents and how we might be able to help you purchase in the Brisbane market. Otherwise, make sure you drop a like on this video and subscribe to the channel down below and click this video over here for more things real estate, renovating, and financial freedom. I'll see you in the next one. Peace.